Lynn, the last time you were on the show, we talked about inflation, and I've seen a lot of references where the growth in the M2 money supply has been used to discount the return on asset classes. Is that a prudent way to measure real returns of whatever asset class you're looking at?
I think for lack of better benchmarks, I think it's one of the best benchmarks that's still available. And one way to think about that is over the long run, because technology improves, right, we have this kind of background negative inflation, deflation that should occur. So, for example, someone used to harvest food by hand, and then we invented the tractor, so one person can now do the work of 10 people, and then we have like self-driving tractors, so one person can do like the work of 100 people, and so the amount of the percentage of our economy that we have to focus on getting food for ourselves has gone down dramatically to 1% of us can take care of that whole thing, and that's solved. And so we have this kind of background disinflation. So when you're measuring CPI, right? So let's say on a normal environment, inflation is 3%. It's not really 3%. It's like so. Let's say the background inflation is -2%. So really, what you're having is like 5% monetary inflation on top of what should otherwise be negative inflation, technologically driven deflation. And so you generally have this gap between money supply growth and CPI. So if you look over the long run in the United States, money supply might be growing at say 7% on average over the long run, whereas CPI might average 3% over the long run. And so you have that gap between the two, and a lot of that is, I mean, one, you have just different ways of measuring it, so people can argue about how accurate either of those metrics are, especially the CPI metric. But then also there's that kind of background semi-permanent technological deflation that's happening. And so when you have, say, zero rates, the problem is if you're using like a 10-year treasury yield as a discount rate for your equity analysis, you'll come up with almost infinite valuation. Like there's almost nothing you shouldn't pay to own stocks, because if you just run the numbers, you're like, well, there's still a positive equity risk premium here. I'd rather own it than a treasury yielding 1.5%. And so you buy it. The problem is that you're then vulnerable to a massive amount of volatility and downside, and you could have 5, 10, 20-year periods where those equities don't do better than treasuries because you can get into a bubble and roll over. And so I think permanently having a higher hurdle rate, a higher discount rate, a higher benchmark than whatever the lowest rates happen to be, especially in some countries they're negative. They're really negative rates. And so I think a proxy that you can use is a smoothed money supply growth rate. And you could adjust it if you want for money supply per capita, or you can leave it unadjusted. It doesn't make a huge difference in most markets. And that'll generally give you, in say a normal market, that'll give you a mid to high single digit hurdle rate, which I think is appropriate for equities. And in a more inflationary environment, it gives you a somewhat higher hurdle rate that could be in the low to mid double digits. Obviously in some markets we have a true inflationary event. You can have massive money supply growth, then you're just in full on protection mode. That's where things like gold and commodities shine. But in general, in most environments, I think the money supply growth is a much better hurdle rate than trying to use something like a long duration bond, because it's like you're filtering out the extremes in some ways. And so when you have these periods of rapid money supply growth without CPI growth, generally you get asset price inflation, right? So that money's going somewhere, and we're constantly, if money supply is growing at say 12% a year, as it has been over the past year, and rates are near zero, do I want to hold this asset that is going up in quantity by that much and not paying me for my dilution? Right, so I'm holding. It's like I'm holding a company that's constantly diluting its shares, and yet it's not paying a dividend and not growing, or growing very slowly. Or do I want to go and buy a company that's buying back its shares? It's actually a deflationary asset, and paying dividends, right? And so I think that's a useful way to think about it, because if you look over the long run, things like gold track broad money supply growth more closely than they track CPI over the long run. So, for example, if you just said, okay, gold should have held up against CPI over the past 50 years, you'd expect that it would have matched that, but it actually beat that. It's actually closer to broad money supply growth per capita over the past 50 years, because it's kind of benefited from both CPI as well as the fact that we're just printing so much more money that when we we compare that money to those assets, we get higher prices than we'd expect because you have asset price inflation.
Let's continue on that thought and specifically talk about valuing gold. I read that you like to compare the price of gold to the growth of the broad money supply per capita. Why is that, and what does it tell us about the current valuation of gold?
So there's two ways to do it, and they give you roughly similar numbers. And so one thing worth pointing out is that gold has an inflation rate of about 1.5% per year on average. And what I mean by that is like the amount of new gold added to our existing supply. If you look over like a 100-year chart, it averages between 1 and 2% a year, and it's almost exactly at 1.5% on average. And that's actually pretty close to population growth over that time. And so one way to think about it is that, there's basically the same amount of gold per person in the world as there was 50 years ago. There's somewhat of a rounding error, but that's roughly true. And it comes down to something like 1 ounce of gold per person in the world. And so depending on the data that you're working with, I think the cleanest way to do it is that you can kind of estimate the market capitalization of gold, right? So there's entities like the World Gold Council that give their estimates for how much of stored gold there is. And then you can go back and look at this long-term inflation rate, which again, we have pretty good data on. And you can kind of chart out the market capitalization of gold over time. And then you can compare that to, say, the US broad money supply over time, or you can compare it to global broad money supply over time, or OECD broad money supply over time. You can pick your benchmark. And I think, comparing those two data points is useful because it kind of gives you at least like a situational awareness. Is gold undervalued compared to that money supply growth? You'd expect over the long run, as we talked about, that if we double the amount of money units in the system and the amount of gold in the system is the same, of course, year by year, you can have anything because it's just buyers and sellers and who knows what they're going to pay for it. But over the long run, we've generally seen that gold keeps up with the money supply growth. And so if you see these unusually strong divergences, it's worth taking note of. And then you can come up with your own conclusion. Maybe you can say, well, Bitcoin's demonetizing gold. Or you can say gold's just super undervalued and it's going to catch up, right? So depending on if you're a bull or a bear, you can interpret that in different ways. But I think it's at least useful to be aware of when it happens. In addition, there are times where it overshoots, right? So for example, we talked about gold going into a bubble in 2011, 2012. By those ways of measuring it, gold had gone up very quickly and then it went up past where you'd expect it to be based on money supply growth. And so it gave you like a sell signal, or at least not necessarily a sell signal, but an overvaluation signal that then people can, again, interpret how they want, right? Whatever other information they might be combining that with. But I think it's a very good data point to know. And so during those bubble periods of 1980, and then again in 2011, 2012, that gave you a warning signal that this might not be an undervalued investment anymore. Basically, it's a very crowded trade. It's arguably been driven up in value higher than it should have been. If you don't want to work through the market cap of gold, another way to do it is if you can just chart the gold price, and instead of adjusting gold for its inflation rate over time, you can go back and look at the broad money supply per capita. So you're kind of factoring out roughly the same growth rate from the other side of the equation. And so either way, you get the amount of gold per person staying the same. So you're looking at broad money supply per capita relative to that gold, or you're looking at the total pool of money and the total pool of gold, and you're taking out the population component, and you're just looking at those compared to each other. And you get roughly similar results just because it happens to be that the gold's inflation rate and human population growth are rather similar numbers over time.
So whenever we talk about gold, very often we hear, well, it's a good inflation hedge, which it is. So a lot of people have this expectation that you could plot gold, the price of gold and the price of inflation, and they will more or less follow each other. But it's not always the case. For instance, if we look back at the 1980s, we had high inflation and gold prices dropped sharply. We should instead look at gold compared to the changes in real interest rates. Why is that?
So this goes back to what we talked about before, where gold is more of a currency than a commodity. And so if you were to chart commodities compared to inflation, you'd have a very strong correlation because commodity prices going up is almost the definition of inflation. I mean, it's a very big component of inflationary environments is the price of commodities going up because those commodities are needed all the time and there's no big stockpiles of them. Whereas gold, because most people don't need it at any given day, other than very, kind of select industries for a small percentage of the market. It's more like investors choosing to allocate to it instead of other things they could own. And so basically what you're comparing it to is like a long duration treasury, if you're in the United States, for example, or if you're a foreign central bank and you're choosing what to have in your reserves. And so in 1980, basically, we had just gone through the 70s. Gold had an absolutely massive run up. It was a very inflationary decade. And then they finally got a handle on inflation. They jacked up interest rates to be higher than the inflation rate. So you have positive real rates. And then you started this 40-year cycle of disinflation. So inflation was still high in the 80s, but it was coming down compared to where it was in the 70s. And then more importantly, even though it was still high, your treasury yields were higher. So you were getting compensated in real terms to own a long duration treasury. And that was true for many other countries as well with their sovereign bonds. And so in the 70s, let's say inflation, at any given point was say 7%, while your bonds were yielding 5%, you were getting devalued. Whereas if you have the same, let's say you have 6% inflation in the 80s, but your treasury is yielding 8%, you have a positive return. And so because gold can be thought of as like an infinite duration, zero yielding asset that has some degree of long-term inflation indexing. On the other hand, when you go through an environment, either because yields got so low or inflation got so high that inflation is equal to or higher than bond yields, suddenly that gold that's yielding zero but that's keeping up over the time with broad money supply, that's a scarce asset, looks a lot more attractive. Zero is kind of like the threshold, but there's a degree. So for example, if real yields are negative 5%, that's more of like an emergency than if real yields like negative 1%, because you're getting devalued at a much faster rate. And of course, the complication there is how do you measure real yields? Because we can, for example, just look at 10-year treasury yield minus CPI year over year. That's one way to do it. That's, historically, that's kind of the cleanest data set we have over the long run. But we also have tools like the TIPS market and inflation break-evens that give us, the investor expectation. Basically, what is the market currently telling us that it expects inflation to be over the next 5 years, for example? And that actually in the current environment is lower than your current CPI. And that's more closely tied to what is happening with the price of gold. So it's not the only variable that's involved, but it's certainly one of the key variables. That basically, if you had an environment of negative real yields, and especially when it's getting worse, when those real yields are getting even more negative, you tend to have more capital inflows into gold. And then it's also, because it's forward-looking, it's more focused on those inflation expectations than what trailing year inflation looks like compared to current yields.